Bloomberg Audio Studios. Podcasts, radio, news.
The Stock Movers Report, your roundup of companies making moves in the stock market, harnessing the power of Bloomberg data.
Christina Aquino is here with us, and she is taking a look at some stocks on the move. What do you have for us?
Yeah, taking a look at Palo Alto this morning, Scarlett. Of course, ticker PANW. Those shares are very much in the red. They're down more than 5%. Earlier, they were down by the most in 2 years, and that is because, of course, we got the results after the bell yesterday. Weaker than expected forecast for adjusted earnings. Earnings per share now, they're looking at $3.65 to $3.70, down from the prior estimate of $3.87. It did, however, boost its full-year forecast for key metrics, including revenue and next-generation security annual recurring revenue. So for JP Morgan analysts, this is actually a positive thing. They're saying that the conservative forecasts provide an attractive setup for the second half of the year, and they're saying that the mixed second quarter results actually presents a buying opportunity, given that it is still very much an AI beneficiary.
All right, very good. What else you got for us today?
We're going to talk about the MSG Sports news, Paul, of course. MSGS, the ticker there. Those shares are up more than 17%, set for the biggest jump on record in data starting 2015. And that is because, of course, we got the news that the company is saying that its board unanimously approved a plan to explore a possible spinoff that would separate the New York's Knicks business from its New York Rangers business. And they're expecting the transaction to be structured as tax-free if it does proceed. And so the spinoff will work out. The New York Knicks company will include the Knicks and the Westchester Knicks, which is apparently a thing. The New York Rangers, meanwhile, will of course include the Rangers and the Hartford Wolfpack.
The AAA team.
Exactly. I know, Scarlett, you will have a lot to say about this.
Well, I mean, it's something that people had been wondering about for a long time because the enterprise value is lower than the values of each of the individual teams. So there's been a lot of questions about why not unleash these companies into their own publicly traded companies on their own.
Yeah.
Okay.
A lot of questions in a row as well about what the streaming service is going to look like. Are people going to have to pay for 2 streaming services now?
Well, that's a different company if you look at the financial structure. But God, that would just make it so much more fun to be a sports fan these days, right?
Exactly.
All right. Next one.
Wings.
Wingstop. So ticker WING. That's also having a good day this morning. Those shares are up more than 15%, set for the biggest jump since July. And that is, of course, stronger than expected adjusted earnings per share that we've gotten from the company. They're also saying that total domestic same-store sales growth for the fourth quarter better than expected. So there was a lot of kind of lowered expectations because key customer segments for Wingstop, analysts were saying looking under pressure. And so the fact that they delivered above estimates on these metrics very much being taken as a positive. Bloomberg Intelligence weighing in saying that the upside to their 2026 same-store sales growth guidance is looking very likely now for 2026, given that comp sales in fourth quarter were less bad than feared.
The Stock Movers Report from Bloomberg Radio. Check back with us throughout the day for the latest roundup of companies making news on Wall Street. And for the latest market-moving headlines, listen to Bloomberg Radio live. Catch us on YouTube, Bloomberg.com, and on Apple CarPlay and Android Auto with the Bloomberg Business app.